Ted, good to speak with you again.
How are you, Moeed?
Pretty good, pretty good. I'm excited about the fact that we're going to be talking about Amazon today. Obviously, not much of an introduction. Hopefully, everyone knows who they are. Since the COVID pandemic, their share price has tripled. And they're now a company that's got a market cap of $1.6 trillion. So certainly one of the most valuable businesses in the world. But a lot of people, certainly a lot of people I talk to, really focus on the share price. Not a lot that I've spoken to have dug into the finances. So I think this would be an incredibly interesting session. So Ted, over to you. What have we found out about them?
Okay, so let's have a look at. So what I've got is their 2019 account. So they haven't actually produced their 2020 account, so we can't see how they fared during the pandemic. But if we go down 2019 and we whiz down through to the accounts, here we can see audited by Ernst& Young. Once again, a very good, solid auditors. And quite interesting, they start with their cash flow. Now, we've talked a little bit about, how companies kind of like to present them. Amazon's cash flow says that they're clearly very proud of their cash flow, but I'm not going to start there. I always like to start with the income statement. So here's the income statement, and we're looking at the right-hand column here. So the right-hand column is effectively 2019, and then the previous 2 years for comparison. And they've split their sales out into two sections. Now, this is quite important. So the product sales, that's what you and I are ordering through the internet, for example, through the computer, as my wife says. And then we've got the net service sales. So the service sales is going to be things like Amazon web hosting, okay, which is an increasingly large part of the business. You can see that has effectively doubled from 2017 to 2019. Their web services have doubled, whereas the product sales, I mean, it's been growing, but it hasn't been growing as quickly. So overall, it's a 30% increase in 2018, another 20% increase in 2019. We'd expect that to be continuing into 2020, but the web services is big, especially as it's really, really profitable. So, but overall, top line, this company is growing. It's growing, as I said, 20 or 30% per year. The cost of sales is growing as well, as you'd expect. And we should really be comparing this cost of sales to this number here. Okay, so this is obviously the cost of the fulfillment. Now, what's quite interesting is if you look at those two numbers, you suddenly say, well, hold on a sec. If that's the cost of sales, and that's what we're comparing it with, you'll notice we're making a gross profit loss. So if you remember, Amazon's kind of strategy is just to kill the high street. They want everything to be bought by Amazon. And I have to admit, I am an Amazon fan. I am an Amazon Prime customer, and increasingly it's like I can't be bothered to walk up the high street. And my high street's only 10 minutes away. I can't be bothered to walk up the high street. I'll just click it. It'll be here tomorrow. It's absolutely fine. So that kind of laziness, and that's what they're hoping to get into. What's interesting, though, is that those cost of sales then need fulfillment. So not only do we need to be looking at the cost of sales, we need to be looking at the kind of, the cost of getting it to me. Now, you could argue that the fulfillment for Amazon, either delivery charge, is the equivalent of the high street store having to pay rent and rates, for example. But what's interesting here is that, and I don't know if this is exactly right, because I can't see the sort of detail behind the numbers, but it looks to me like Amazon is using the money it's making from its web services to supplement its loss-making sort of fulfillment delivery service, because it's just trying to kill all the competition, and then it can put its prices back up. Okay, that's kind of what I'm reading into that. Then down here, we've got the technology and the fulfillment. So that will be, technology and content. So content will obviously be, this will be Amazon Prime, remember? So they're trying to compete against Netflix in terms of their Amazon Prime. And again, I'm a Netflix customer, but I buy Netflix for Netflix. Amazon, I kind of get Amazon Prime as an add-on. I don't buy Amazon Prime to get access to their content. I get it so I get my stuff delivered, the next day, and I don't have to pay for it. So it's for free, in inverted commas. Little bit on marketing. I say a little bit. I mean, 19 billion is quite a lot, but it's you know it's a fair amount on marketing. And then there's this general and administrative. So the general and administrative will be the kind of, you know, the back office, the sales, not the marketing, because we got the marketing split out. So it's sales and finance and HR and rent and rates. So the fulfillment here will be not only the cost of sending the products out, but it'll also be the costs of the warehouses. I would expect the cost of the you know, the staff who are doing that fulfillment effectively. So that's quite a big overhead. So quite interesting looking at this company and how they've kind of, you know, so the total operating expenses here have obviously been growing the same as the line. And so the operating income, this is effectively their operating profit, their kind of their trading result, and they're maintaining 5%. It was 5% last year, it was 5% this year, it was actually 2% in 2017. So, you know, top line, big numbers. You know, we're talking about, you know, $250 billion of sales, yet the kind of, you know, the actual profitability is actually quite small. They're operating on razor thin margins. And it looks to me from these numbers that they are running their kind of order fulfillment at a loss, which means that the high street is never going to be able to compete with that. And they're killing the high street as a result, and they're supplementing it through their web services. Now, this net service sales, this may include Amazon Prime, I don't know, and in which case there's going to be a cost somewhere in here related to that. So we can't see exactly how profitable that is. They'll have that now proprietary information in their business. Last thing to notice is that they are paying some interest here, and that'll just indicate that they've got some debt, but the interest they're paying compared with their operating income, it doesn't keep them awake at night. So they're making 14 billion of a profit, and they're paying, you know, 1.6 billion in interest, which is only 1% of their sales. Let's go and have a look at their balance sheet, see how strong they are. So here we see the top half of the assets. So here we've got the current assets, things we own, which are cash or going to become cash soon. So they've got this is cash. This is also cash, these marketable securities. So we need to take these two numbers together. We've talked about marketable securities before, Moeed. So this is effectively, you know, investments. It's just a way of parking cash. So they've got, what's that, about 36, 46, 50, $54 billion in cash. They've got quite a lot of inventory. You'd expect that because that's their business model, to hold the inventory so they can deliver it to me the next day. And they've got a little bit of accounts receivable. And then down here, this is all their property, plant and equipment. So they're going to have lots of warehouses. And it looks to me, I'm guessing that this number here, this 25 billion, is going to be the operating leases on warehouses. And actually, that's going to be sort of, you know, funded through this number down here. So you can see there's a big jump here. This was zero. It may be an accounting treatment, I don't know, but it looks to me like, you know, there's not a sort of a big issue there. They've got some goodwill on acquisition, hasn't really changed. Few other assets, property, plant and equipment is growing. They're probably buying warehouses as well as leasing them. Current liabilities is actually quite high compared with their current assets. So, you know, it's not a problem, but, you know, we can see that it's you know, that they've still got enough assets to pay for their to cover their current liability. So the working capital doesn't look too bad for this company, and you know, there's nothing else in there that's really kind of keeping me awake. We expect they've got some long-term debt. There it is. Really not a problem in terms of the debt. It's easily affordable, so not a big issue there. All of that comes down to the net assets of the business, which is equal to the shareholders' funds of 62 billion. That's this number here, and that is effectively the accumulated loss. So you can see here, this is their retained earnings, and this is the investment that was made into the company. So you know, they're profitable. They're holding on to those earnings. I don't think they're paying out any dividends. So this is they got a good strong a good strong balance sheet going on here. Just have a quick look at their cash flow statement. here is their cash flow, and they sort of effectively what they're doing is they're reconciling. There's their operating or their net profit, and you'll notice that here is the cash profit. So this is the cash profit from operating activities. It's effectively the cash equivalent of their operating profit. If you remember, their operating profit was about 14 billion. They're making 38 billion in cash. So very, very, very strong cash flow in this business, and that's going to be partly driven by their web services. Again, people, they're kind of the iCloud services. People pay for that service storage, and then they actually use it. So they're going to have really strong cash coming through, and that's really going to be, I think, a major focus of this business, is that they are growing that, and they're going to continue to grow that as hard as they possibly can, because that's really where the money is, and then they can use that to grow the kind of the product and the delivery business, and to kind of continue that kind of those tentacles reaching out into all parts of our life. Bottom part of the cash flow statement, just have a quick look at it. So we got the investing activities going on. So they are investing property, plant, and equipment. That's good. Don't worry about these two numbers here. This is just purchasing and selling our marketable securities. So really, we should just ignore these numbers when we're looking at cash flow. This is just effectively, I put my money in my deposit account, I take it out of my deposit account, I put it back in, I take it back out. Okay, so that's really just, they have to account for it like this, to state it like this, but actually that's just, moving from cash to cash effectively. So this is really where the investment is going on. We can see they're investing, and a little bit of refinancing going on in terms of their debt. So they're issuing debt to repay debt. That's absolutely not a problem. They've got these finance leases. So, and they're not paying any dividends. So, and Amazon isn't trying to pay dividends. They still think of themselves as a kind of a young, growing company. They're kind of trying to take over the world. They're holding on to that cash to give them the cash to kind of, to expand effectively. So, that's a real whistle-stop tour of Amazon itself. Looking at the share price, you mentioned the share price has gone, it has gone ballistic. So here is the kind of the meritocratic rise of Amazon up to a market cap now of $1.6 trillion. So that is the kind of the market capitalization of the business. The net asset value that we've just been looking at, that's from the balance sheet. If you remember, that is the equity that we were looking at. Let me just pull that number up for us so we can see the number that we're referencing there. So we're absolutely clear. So on the balance sheet, we're talking about this number here, this 62, which I've now just put next to it. So that's effectively the shareholders' funds, which is left over if you sort of effectively close the business down. So basically, this company is all goodwill. If you buy a share in this company, you're not actually buying an asset of the company, you're buying the future potential earnings. P ratio is here, it's 77 times earnings. So we're not in Tesla territory of thousands of times earnings. So 77 times earnings is expensive. It's but it's a growing company. It's growing 20% a year. So if it doesn't grow at all and it does nothing else, it'll take you 77 years to get your money back. But it is growing, and will it continue to grow? Will the regulators start to get shirty? We think about some of the corporation tax challenges that are coming out in America, although to a large extent you could argue that doesn't really affect Amazon because they don't make a huge amount of profit, and therefore they don't pay a huge amount of tax. Top line very, very high, but bottom line relatively small. They're only on a 4% net margin, as opposed to people like Apple, for example, who are on a much higher bottom line net margin. So it's it's a good company. I'm not sure if honestly, I can't remember if I'm a shareholder. I think I might be a shareholder in Amazon. No, I'm I think I am a shareholder in Amazon. I've got a few shares in it. It's not screaming buy. I'm not sure it's necessarily screaming sell. It's expensive. It looks a pretty good company, and if you buy a share and you're looking for it to double, then you're hoping this is going to become a $3.2 trillion company. That's quite a big tall order. So it's a good play, but certainly looking at that share price, I think if you're looking for a kind of a big bagger, you probably missed the boat on this one. Maybe 1996 was the time to invest, as you said, Moeed.
Yeah, apparently, and I looked at some numbers, and if you'd invested $1,000 in 1997, that thousand would have yielded just over $3 million right now. So
Well,
yeah, I agree with you. I think
that's the benefit of hindsight.
yes, of course.
Moeed, and you know, if I could invest with the benefit of hindsight, you know, we'd all be multimillionaires. So
yeah, exactly. But I agree with you. I think the multi-bagger, you know, 5 times, 10 times your investment is probably gone. However, your point around 3.2, you know, if you're expecting it to become a 3.2 trillion company, don't forget, just a few years ago, it was almost unheard of, or we were really surprised that Apple was going to become $1 trillion business. And now it's worth 2 trillion, and now there are 2 or 3 companies that are worth $1 trillion. So not unheard of, may happen, right? If they continue to dominate as they are, that could be very possible. But I thought this was a very interesting whistle-stop tour, as you said. There's a lot in their annual report to get into. But let us know what you think, viewers, right? So what are your thoughts about Amazon? Do you think it's a company that can realistically come to $3.2 trillion in market cap? As always, if you have any particular company that you would like us to investigate further and analyze for you, leave a note in the comment section. Please like, share, subscribe this video, and we'll catch you on the next video. Thank you. Thank you very much, Ted.
good to see you, Moeed. Have fun.